Relative strength is weakening, markets are rising.
Yeah.
So that's just, and generally that typically that type of action precedes larger corrections. So Monday, September the 1st, it's a holiday. But September tends to be the weakest trading month of the year. So if this negative divergence is going to show up in the markets, it's likely going to show up in September.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the portfolio manager and Swiftie, Lance Roberts. Lance, how you doing?
Hey, I am all on the Taylor Swift board. You know what? I found some amazing statistics about Taylor Swift. I had no idea. We talk about this social media economy that we're in now, and everybody's social media driven. Taylor Swift has over 400 million followers on her social media platforms. That's more than the population of the entire United States. I was like just blown away by that. Her dress that she wore for her engagement with Kelsey
And I
sold
know it's a
out.
Ralph Lauren dress. That's how much
Yeah, it sold out in like 15 minutes. Every size that they had was sold out just after she posted and that, and it's interesting because when you talk about her Eras tour that she did, we talked about the economic impact of that and that it actually boosted GDP growth
Yeah, it
because
was
of all the people.
visible in the GDP. Yeah.
It was because of everybody, renting hotel rooms and buying merchandise and traveling and airfare and all that. It's going to be interesting to see, how much of an economic impact we get out of this whole engagement wedding process.
So it's funny. I had this to ask you at some point in today's list if we had time. But yeah, I mean, there's been FinTwit's been hot with
Yeah.
discussion of like, so is this going to inspire a whole bunch of copycat engagements? And then everyone's like, and pretty soon after this marriage, there's going to be a Taylor Swift baby, and then is there going to be a baby boom, basically caused by all these people trying to get pregnant at the same time that Taylor Swift is? So, I mean, a question I was going to ask you tongue in cheek, which if we have time, we'll get to, but is like, could Taylor Swift rescue the slowing economy here?
It's entirely possible. And let's remember, Taylor Swift's been engaged before, right? So and if you go, TMZ ran this great article.
Has she really? Okay, you just passed. I've got two daughters. You've now sucked up all my Taylor Swift trivia knowledge. I didn't know she was engaged before.
So yeah, her whole life story is just failed relationship after failed relationship. But um, you know, TMZ ran a really good article on Monday, and it was all the odds, the betting odds that are going on right now with, odds on bet are the wedding will be in Las Vegas, or the engagement, the bachelorette party will be in Las Vegas. Where's the wedding going to be? What's the over under on who's the maid of honor versus best man? And there's just all this. We've turned. In fact, this weekend's article that I'm writing for the Bull Bear Report, Saturday's newsletter, is the fact that we've now turned the stock market into a entertainment market, and we're now betting on all kinds of stuff. For instance, like the Chicago Mercantile Exchange, which does a lot of options trading, has cut a deal with FanDuel. That opens up the whole opportunity for options trading against potentially, if you kind of extrapolate this out, maybe I could buy call or put options on whether or not Dallas makes it to the playoffs this year. Sorry, I had to laugh. But you know, you get on Reddit as an example, and there's whole Reddit boards that are up that are just memes about investing. Whether it's, so there's one of the examples I'm using in the newsletter is talking about irresponsibly long MicroStrategy, and it's just meme after meme after meme of people that are loading up on MicroStrategy stock on this whole bet that MicroStrategy is going to go to $1 million a share or whatever the number is. Even Michael Saylor himself has been posting memes about himself to promote MicroStrategy stock, which I think that kind of borders into stock market manipulation. But we'll see if anybody ever says anything about it. But the juxt of it is, and this is the interesting thing, is that we've now, through online betting, you can bet on pretty much anything. Polymarket just got a new investor into Polymarket. It's got a huge valuation on that company, but basically you can bet on anything.
Right?
Yeah,
isn't it Don Jr.? Yeah,
it is. He's actually invested on both sides of the mix right now as well. But you can bet on anything from political outcomes to, Taylor Swift's wedding to, what's happening, with some economic piece of data. But we're just turning more and more of the stock market into this kind of this gambling type scenario rather than investing for, future returns and economic growth. We're now just turning it into an entertainment game where it's like, oh yeah, well, I could play a video game on my phone or I can, bet on stuff on the stock market on my phone as well. The outcomes of that obviously aren't going to be good at some point, but it is a very interesting change in the dynamics of how we're, looking at the markets today.
Yeah, you're depressing me here because yeah, I don't think this is good nor ends well. And it's funny because for decades, those who have thought when the stock market was irrationally valuing assets, you refer to it as the casino, right?
Right.
But you're talking about, it truly becoming a casino, right? I mean, the stock market in theory is a way to capitalize enterprise, right?
Hmm.
And that makes sense, right? Hey, if we want to have the economy grow, well, we have to provide a way for companies to get the capital they need to get formed and get out there and make the investments they want.
Sure. Yeah.
When that capital just gets used to speculate on who's going to be the groomsman at, some rock star's wedding, what benefit is that, right? Or the
Right.
call options on the Dallas Cowboys, right? I mean, there's no economic value in that exchange at all,
Well, exactly. And
or
also,
economic value creation. Yeah.
right. And also, when I'm kind of options trading or betting, so to speak, in the markets, I'm just doing straight betting like on FanDuel or something else. That's not really providing capital to anything that creates future economic growth. All I'm doing is just shifting capital between two players, right?
That's my
You
whole point.
you
Yeah.
you lose all your capital, I get all your capital. That's it. So if
Right.
I go
And the
spend your
exchange takes a
capital,
cut.
right, yeah, yeah. And so if I go spend your capital in the economy, great, but you're not creating jobs, you're not creating, research and development or anything like that, where where like an IPO as an example would bring a company to market, create more jobs, those type of issues. So yeah, it has, it's not the benefactor that the market should be to overall economic prosperity, but you're creating a much more defined niche of who's participating and who's not participating. And the winners and losers in that are going to be a lot bigger.
Yep. No, agreed. To me, it's sort of the financial equivalent of, digging a ditch and then filling it back in, right?
Hmm.
And the problem is in the process of it, if that's, where your investors are spending their time, they're not developing the skills to be true investors. They're just wasting their time in this sort of mindless navel gazing uh, uh, entertainment that you're talking about. And,
Yep.
unfortunately, because it's entertainment, it's going to suck in the less experienced, the less serious, the younger for the most part,
Yep.
right? They get attracted to the stuff, and they're probably going to get burned in time in the casino. The odds always favor the house, right? So
Yep.
you're not teaching them how to invest, and then you're going to burn a lot of them, and they'll probably then swear off of investing going forward, and then you have a lost generation of investors. So,
Yep.
all right,
No, yeah, lots of negative consequences, but
this turned into a rant right at the beginning of the video here, which you didn't mean to do. All right, well, look, we got a lot to talk about. I'm going to jump in just a quick second. Just want to give a reminder to folks that the Thoughtful Money Fall Conference is available for registration now, still at the low early bird price. Breaking news, we just had Sven Henrich agree to sign on as faculty again this year. So he will be giving his latest very deep, thoughtful, technical analysis. So he'll be walking through a lot of charts that he'll be making just for this conference. So anyways, to sign up for the conference, if you haven't already, go to thoughtfulmoney.com/conference to sign up. And if you are a premium subscriber to our Substack, make sure you look at the email that I've sent you that has the discount code that you can use to get an additional $50 off the conference. All right, Lance. Well, look, this week again, the markets hit all-time highs. They're off a smidge the day we're talking here,
yep.
but you know what me worry, right? The old Alfred E. Newman from Mad Magazine, right? Markets don't really seem to have a lot of worry here. That said, we had kind of a notable development this week, which was that Nvidia had its earnings,
Hmm.
and you know everything was good. The question is, was it good enough? I mean, I think in general, another blowout of everything.
Right.
But the market was nonplussed, we'll say.
Yeah.
It didn't jump, kind of a rare down a little bit. And my question for you here is because Nvidia is such a massive driver of the U.S. stock market now. In fact, I just heard that if Nvidia was a stock exchange on its own, I think it would be like the third largest in the world at this point in time, market cap wise.
Yeah.
But are we getting to the point of peak Nvidia where it's just, trees don't grow to the moon? At some point, it just can't keep uh, dragging animal spirits higher every time, or is this just, a pause in a magnificent continued run?
Well, well, first of all, I mean, you got to kind of put all this in perspective. Is like, okay, so first of all, excuse me. First of all, one of the most interesting things that came out of that is that every options player lost money on Nvidia, which was very interesting.
You mean like on both sides?
On both sides. The people that were buying calls expecting the stock to surge, they lost money. People that were buying, puts for a big decline, they lost money because the stock was only down like 1%, maybe less than 1% yesterday by the close. It's down a little bit more today, but you know, this stock's had a huge run. It's up like 100% from the lows of April. So, all the, and it was interesting because if you take a look at the earnings, the revenue growth, et cetera, they blew it out across the board again, as usual, just, great numbers. And they didn't even include in their revenue statement any of the chips they're selling to China. They just assumed that there's going to be no sales to China, and they still killed it. So, the only thing that was a little bit, what got the stock is that as we go into earnings, there's always the estimates, right? So here's the estimates we're all expecting. And then Wall Street has all these whisper numbers that are out there, which are these even higher numbers. It's like, hey, this is what we expect, but they could report this. Well, they beat all the earnings numbers that they had out there. They just didn't quite hit the whisper numbers on, a couple of metrics, which, is really kind of nonsense, but you saw a little bit of a sell-off in the markets yesterday. But this, again, the stock had rallied for 5 days going into earnings. So again, a little bit of profit taking there, really not surprising. But yeah, no, the stock is very, very overbought. It's had a huge run. Would love to see a bit more of a correction. It's correcting right now. The stock's down about three. It's at 174 right now as we're talking. It's down about 3.5% on Friday. I would love this thing to pull back to somewhere in the 150 area would be awesome. Give you a great opportunity to add more into the portfolio at that point.
Okay. So, I guess just to the spirit of my question here, though, Lance, are you seeing this as like, hey, whatever, this is just a cooling off? I mean, the stock ripped
Yeah.
100%, like you said, over the past couple of months. Or is there anything here that we can look at either in its results, its guidance, or just its valuations that could signify, this thing is just not going to keep outperforming stock wise, forget about results wise, but stock wise, the way that it has so far, that the market's just become accustomed to?
Sure. I mean, eventually, their margins are going to shrink. They did in this time, which was expected, but they didn't. Eventually margins are going to shrink. Eventually there's going to be another competitor, whatever it is. Eventually they're going to miss on some metric, whatever that might be. But that hasn't happened yet. And again, you take a look at the underlying fundamental growth rates that this company is generating right now, with the expectation of what's coming in terms of data center build outs. This stock has more room to go to the upside. We're very young in this cycle for AI development build out. It's way too early to be calling, oh, is this a top? And until you start to see CapEx expenditures come down, and when you're talking about, Microsoft, Apple, Amazon, and Google all spending $1 trillion each over the next, really 4 years going into 2030, building out data centers. That's $4 trillion worth of data center build out that's all going to be using the racks, the chips, the GPUs, et cetera, from Nvidia. So you're just way young in this cycle. Now, if something comes along, all of a sudden everybody says, oh, AI was a fad. You kind of like we did with the internet in 1999.
Hmm.
Internet's a fad. It's never going to catch on. So if we don't need to build all these data centers, if we don't need to build out AI, if that becomes a fruition, absolutely, Nvidia is going to be, struggling to keep valuations. But valuations are not expensive. You take a look at the company. Ford P's 27. It's got a PEG ratio, which is price to earnings growth of 1.45. So this is not an expensive company based on its trailing earnings growth.
Okay. What's its price to sales these days?
Price of sales based on Ford is about 9. Trailing is about 25 right now, but that's come
Okay.
down from over 100.
I was going to say, which are rich and mind-blowing, but yeah,
Oh,
uh,
really? Yeah, because
but muted compared to where it's been
yeah,
during
yeah.
some.
Well, it's growing into its valuation, which is kind of the important part about that. But take a look at Palantir as an example. It trades at a price to sales of 225. So, you know,
Yeah. All right. Well, you said, if somebody if something yeah, if somebody comes along and says we don't need all this stuff, right? That hasn't exactly happened yet, but we had somebody come along and say, "Wow, AI is clearly in a bubble," and that was Sam Altman.
yeah. And that lasted about 2 seconds, and the stock ran up. So,
Right, right, right. But I mean, notable developments just in the sense, and look, there's a lot of speculation. Well, he's doing that to try to maybe cool investment in the space, and that'll hurt his competitors more than it'll hurt him. I mean, who knows what he said it for? But I mean, this is sort of like LeBron James saying, yeah, maybe basketball is not that cool of a sport, folks, right? It's just it's one of the superstars in the industry, basically saying, look, I think we're in a bubble. We'll see what happens from that. But I want to pivot on that bubble. So I just released an interview with Cem Karsan.
mhm.
And I think you're familiar with him, Lance.
Yep.
But big volatility expert, has a really interesting way at looking at the markets and the economy. It's differentiated from most of the people I bring on this channel, and I always really like it when somebody brings what is a really interesting sort of new way to view the world. But he is definitely planted the flag. Look, we're in a bubble, and I don't think you necessarily disagree with how he looks at it. He says like this is a bubble, folks, by like any metric that we use. Like this is a bubble. Now that being said, he's like, bubbles can go a lot higher than you think. So I'm not calling the top here, right, by any stretch. And he says, I still think there's. He's big on playing volatility. He's like, I think there's, you know, good opportunity to still make money to the upside here in this market for as long as it runs. How
Mhm.
long is it going to run? I can't tell you. Um, but I, he's got an interesting thesis on how it might resolve. Before I get there, let me just ask you this. Your partner in crime there, Michael Lebowitz, published a report this week titled Momentum Strategies in Physics. Mass
Mhm.
and velocity matter.
Yep.
What are the key takeaways from that Michael was trying to express?
So, so back to it all kind of ties into what you're talking about. Are we in a
Yep.
bubble? Yes, we're in a bubble. And, so eventually Nvidia, Palantir, all these companies, they're going to break. And there's going to be large downside swings in these stocks, 50, 60, 70%. That's not going to be uncommon. We saw this during the dot-com bubble. The problem is the timing of all that. And again, kind of to Jan's point, which is that are we in a bubble? Yes. Where are we in the bubble? Nobody knows. But a bubble can last 4, 5, 6, 7, 8 more years. If you go back and look at 1995, we were in a bubble in the dot-com business in 1995, 1996. Alan Greenspan comes along and says, "Hey, we're in a bubble. Everything's expensive. 4 more years before it finally blew up." And you lost. If you listen to that, right? You listen to Alan Greenspan, got out of the market, irrational exuberance, got out of the market in 1996. You missed a huge run of wealth building capability going into the peak of the market in 2000. So what's important, and this is to Michael's point, is that mass and velocity, which is basically volume. Velocity is volume. I mean, sorry, mass is volume, and velocity is the price movement. Those two things are what drive markets. And the problem with following momentum strategies is that momentum comes on way too late in the game. So by the time you realize that, oh, I need to be in this, group of stocks because those are the hot ones right now, you've already missed a big chunk of the move because momentum measures of momentum don't start recognizing a momentum play till well after it's come off the bottom. Now you'll
Right.
remember a couple of but this is why we work differently in our shop. And one of the things that you and I talked about 3, 4 weeks ago was that technology was way overbought. Healthcare was super underloved. Nobody wanted to own healthcare. Healthcare sucked. And we said, hey, there's a good opportunity in buying healthcare now because when we get a rotation out of technology, which is the momentum trade, it's going to rotate to the areas of the weak pockets in the market. And healthcare is going to be one of that pickup. And since then, healthcare has done very well. It's been a very great it's been a good rotation trade and a good counterbalance to some of the weakness we've seen in technology. So we're just now starting to see healthcare start to show up in the momentum indexes. So they're now starting to show the momentum trade, but you missed all that run up to this point. So you've missed a big part of that. So, it's important to pay attention. And this is the hard part about investing is that by the time that most retail traders see a move in something, it's closer to the peak than not. And this is why generally, investors do the worst thing ever, which is they go, oh, look, um, just picking an asset, right? Gold's been hot this year. I'm going to buy gold. But if you go look at the periodic table of returns, what you'll see is that whatever the hottest trade in the given year is typically lasts 1, maybe 2 years, and then it falls to the bottom of the list.
Right.
And whatever was at the bottom of the list goes to the top. So, this year it's gold. Next year, gold may be the worst performer, and it's going to be, small cap, mid cap may be the hot performer next year. But what happens with most investors is they see what's hot, they go buy that near the peak of the momentum trade, and they get swept up in that downdraft when they should have been buying what was out of favor, looking for that to come into favor.
Yep. Yep. So my point here is the momentum is clear to see now, right? And everybody's jumping on, rightly or wrongly, probably wrongly, timing wise. So you, on top of Michael's post there, which thank you for elaborating on it, you then wrote a post this week titled, well, basically sort of asked the question, like this has been a buy every dip. A buy every dip market. So, should that be the standard operating procedure until conditions change?
Right. Yeah, no,
Well, I'm asking you that question. Should it be?
Yeah. Well, it's working, and the problem is that we're changing the dynamic of the markets. And again, this is what we're seeing right now. We kind of talked about this earlier about this. And again, this is the subject of this weekend's bull bear report, which is this entertainment market. And retail investors have been buying every single dip in the market under this premise that either A, they're going to get bailed out by the Federal Reserve. The Federal Reserve is going to cut rates, or they're going to do QT, whatever. And we've been training them this way for 15 years, right? I mean, over the last 15 years, every time there's been a crisis of some sort, whether it was the Japanese earthquake, tsunami, Godzilla event that shut down manufacturing in Japan, or whether it was the Brexit Eurozone crisis, or whether it was the Greek default, those should have been much more significant macro events that drove markets lower. We should have had, going back to 2009, we probably should have had 2, 3, or 4 bear markets since 2009 that were cut short, whether it was Silicon Valley Bank crisis or whether it was, the pandemic crash. Every time though that something like that happened, the Fed stepped in, started doing QT, started cutting rates to zero, whatever it was, to help bail those things out. Well, we've now trained investors that, and this is the definition of moral hazard, which moral hazard is simply says that if I told you, right, I say, Adam, we're going to fly up in this airplane and you're going to jump out of this airplane without a parachute, but I guarantee you're not going to get hurt because I'm going to give you insurance, whatever that insurance is, right? You say, okay, I'll jump out of the plane. And you do it. And hopefully there's a big net at the bottom that catches you. But what we've taught people is that they can take on as much risk as they want because there's no negative consequence of risk taking, right? There's an insurance policy sitting there to guarantee them against the risk of loss. And that moral hazard has been getting built up in the markets now over the course of the last 15 years. And so we've now created this whole mental mindset, how to invest in the market, which is just simply to buy every dip. And that's going to work until at some point it doesn't. And unfortunately, people are going to see the market down 20 at some point, and they're going to buy that dip, and the market's going to keep going down, and it's going to keep going down at some point. that'll happen, right? But the problem, and again, I want to be really careful about this. I don't want anybody running off from this video saying, "Oh, Lance said the market's about to crash because we're in a bubble and buying the dip isn't going to work." I'm not saying that at all. What I'm saying is that buy the dip strategy is going to work until at some point in the future it doesn't. And the Fed doesn't step in, it doesn't cut rates, it doesn't do QE, it doesn't do whatever it is. But that could be 5 years from now, that could be 10 years from now, that could be 20 years from now. Who knows?
Yeah. So let me ask you a question based on that. So I'm sure there's a number of people who are listening to this right now, Lance, and saying like, "Yeah, Lance is right. I've been feeling this forever. This market is just this pig has got to go down at some point in time
Mhm.
because of all the imbalances that Lance just talked about." But to your point, it's the age-old question of timing, right? And we just don't know. Could be tomorrow, probably quite unlikely for that. It could be 20 years from now, at which point it's kind of immaterial at today's time frame, right?
Right.
So let me give you an analogy, and then I'll ask the question. So over the decades, I've had people who are real worried about America's debt situation and the purchasing power of our currency and stuff like that, right? And they have asked me questions about like, is it safe to keep my money in a bank, right? Or I've got some gold coins. Is it safe to keep them in a bank safe deposit box or whatever? What if the bank shuts down and I can't get to it, right? What if there's a big bank bail-in like they had in Cyprus, right? Like it's an understandable concern. It's just probably not a highly likely concern, at least not where we are in the storyline here. And my general feedback to folks on that has been that, but also like we should see enough signs that something that
Mhm.
dire is coming in advance that it's probably not something you're just going to wake up tomorrow and the whole banking system is shut down, right?
Right.
We'll probably see signs of stress in advance. We'll see credit spreads start to blow out. We'll see a rush to safety. We'll see more draconian government edict. I mean, there'll just be sort of storm clouds building that if people are paying attention, they'll say, all right, the risk is building. Maybe now I should start thinking about this, right?
Right.
Do you feel the same way with this market
Oh yeah.
distortion that you're talking about? In other words, like we don't know when it's going to happen, but will you as a capital manager will likely start to see signs before it happens that you still won't be able to like time it immediately. You won't be able to get surgical and get out the day before it all happens.
Yeah.
But you'll see the risk factor goes from a 2% probability up to a 27% probability. You'd be like, all right, that's enough for me to start really de-risking here now.
Yeah, and again, but again, if you go back and view our videos over the last few years, Gio and I've done, we do this on a regular basis. In October of 2022, I wrote that whole article about, there's, likely this is the bottom of the market. It's time to start getting in, and if there's three reasons why: it's buybacks, it's earnings, these type of things. Um, you know, and then at times I'll write articles about, hey, this market's really, really overbought, extended. We're going to have a 3, 4, 5% correction here, and then we'll have that correction, and then we'll buy back into the markets. Back in February and March, you and I were talking about, hey, markets are really extended here. We've got these indicators are telling us markets are going to have a 3 to 5% correction. It turned out to be 20. But we sold down tech stocks, early, and we were buying them back on April the 7th. So it's just about a function of navigating markets. And this is one of the things that, kind of baffles me for a lot of people is that they're like, oh, I can't be in the market because the market's overbought. Well, you can be in the markets. Do you know that there's very little difference in the rate of return of buying a stock at all-time highs versus buying a stock at, after a correction? Because markets tend to rise over time. And yeah,
If
they're
you
going to
if
have a
you hold it
correction.
long enough.
Yeah, yeah, and again, it's always about investing, and we talked about this last week, like you just mentioned, worried about the purchase power of the dollar. Well, yeah, if you just stick your money in a bank and it's paying zero, which we had for a very long time, that's hurting you, right? Because you're losing when your money market savings account's paying zero, and you have inflation, you're losing purchasing power of that dollar. So you have to invest it in something, whether it's gold or stocks or whatever. And what you want to find is the best investment to grow that money over time relative to the rate of inflation. And so again, it's should you not worry about market dynamics and market statistics, and should you not worry about valuations being near the second highest level on record? Yes, you should worry about those, but those are long-term indicators, and those are are, tell us a lot about the future return of the market, but tells us nothing about what's going to happen over the next 1 to 3 years. All those high valuations are a function of sentiment. The reason valuations are high is because everybody's bullish on the stock market and they're going up. So this is why we have to manage risk. We can't just, and this is why I disagree with buy and hold. Just sticking your money in the market and hoping for the best, that's probably not going to work out well for you. But this is why we talk about active management here every week. We talk about, hey, this
Yep.
sector is really overbought, this sector is really oversold. Think about taking some profits here. Think about adding some money over here. Sell some tech, buy some healthcare. That's worked out really great over the course of the last 3, 4 weeks, despite what's been going on in the markets. So you just have to manage and navigate your way through this. And eventually, to your point, Adam, we're going to start to see credit spreads start to rise. Credit market will tell us when there's a real risk of something coming, whether it's a market event, a geopolitical event, whatever it is. If there's something out there that's going to come that's going to really impact the markets, the credit spread market will show us. We're watching that closely. We're watching the technicals. The market will start to break down. You'll start to see lower highs. You'll start to see lower lows. You'll start to see a function of these things start to build up in the overall marketplace, and you'll know it's like, okay, there's some clear evidence here that this market is now beginning to deteriorate. I need to raise more cash, get more defensive, buy more bonds, whatever it is, because I want to protect myself against that. Then you let that cycle go through. And then importantly, and as you and I have talked about before, Adam, the key thing when somebody tells you, hey, the market's going to crash, we're in a bubble, the market's going to crash. Great. Tell me when it's going to crash, and then tell me when to buy back in. Everybody will tell you it's going to crash, but they never tell you to buy back. And so that's the other important part of this, because we saw a lot of this following the financial crisis. We saw people get out of the market. Problem was is they just never got back in again. And we still today have people come in our offices, hey, I got out in 2008 and I need to get back in now. I just can't sit in cash anymore. I've got to get my money working. It's been 15 years. Where have you been? But that's a real life situation. So it's important to understand is that yes, we've got to navigate our way out of the market. We also have to navigate our way back into the market. And that's going to be when it feels like the worst possible time to invest is when it's going to be time to start buying again.
Okay. So let me connect another dot here back to Jam. And again, folks, nobody knows exactly what's going to happen. We're all talking about, possibilities and probabilities here,
Yeah.
Which is why diversification is important too, so that, if your main thesis is wrong, hopefully you have a little bit of backup there. But Jam is thinking that not just for the current market dynamics and current levels of valuation, but for his macro outlook as well. He basically sees a non-dismissible potential of like a lost decade ahead in the markets.
Yeah.
And I know you could see that too, and we've
Sure.
talked a lot about, and we've shown Hussman's charts and stuff like that. That just when valuations get stretched like this, essentially you're pulling future value into today, right? And what does that generally do? It creates a returns drought because you have to basically work off everything that you pulled into the present from the future.
Right.
But he says that could materialize not so much in a nominal crash, like the reckoning of the bubble. Might not be so much of a nominal crash, like, oh, we zoomed up to crazy heights and then it all lost 50, 60% or whatever, right? It could be, maybe there's some adjustment. Maybe it comes down 15, 20%, but then it just grinds and bebops its way sideways for like the better part of a decade. And what was interesting is he went back historically in the markets and said, I can't remember how many distinct like 10, 15 year periods there was of sort of like, these lost periods. And you said, if you go back, and I'm doing this from memory, so folks, if you're interested, go watch the interview with Cem. But over some very long time frame, and it might have been for as long as we have, stock market data, I think he said those lost periods were the majority. They were like 55% or whatever of the data series. And he said in the periods that weren't stuck in those lost decades, you had fantastic returns, as a long-term investor. But he said, this sort of lost decade concept, it's not like a fringe idea. It's actually something that we've seen a fair amount over time. We've just been really blessed to have lived through a pretty long, prolonged period of great returns in the market. So it's hard for us to imagine.
Actually, you spend about 15% of your time making new highs. You spend 85% of your time getting back to new highs. And
Hmm.
that's what people don't understand is that, it's like when you look at a long-term stretch of the market, you go back to 1900s, like look at the market over this long period of time. To his point, he's absolutely correct. You go from 1900 to about 1918, 1917, the market went nowhere. You had a mini depression heading into 1920. Then you had this big run to 1929. Then you went nowhere until 1945, 50. Then you had a big run into the 60s, and then you went nowhere from the 60s through the 70s, and then you had your run in the 80s, and then you went nowhere from 2000 to 2013, right? So you have these very long periods where markets don't make any returns. But if you were smart enough to buy the bottoms, you did great, right? If you were Warren Buffett buying the bottom of the market in 1974, you did fantastic. Just most people don't do that. They start investing closer to highs than the bottoms. Again, we go back to 2009. How many people got out of the market in 2009 and just didn't come back, right? And they missed all these returns. So, we look at markets like, oh, we're hitting all-time highs. This is great. Yeah, we're in that 15% of the period where markets are making and manufacturing new highs, and that'll run for a while. And again, when we talk, and again, you look at this goes back to our valuation conversation we had a little earlier. Valuations tell you nothing short term about the markets. That's all sentiment. Valuations are high right now because of investor sentiment, super bullish. So we're willing to overpay for everything. But what valuations do tell us over the long term is what returns will be. And those
Right.
returns are going to be closer to zero. Now, be careful with that statement. That doesn't mean that every year is going to be a zero rate of return over a 10 or a 20-year period. It means you're going to have some boomer years, up 10, up 15, up 20, and then you're going to be down 10, 15, 20 for a year or two. And then you're going to be up 10, 15, 20% for a year or two, three. Then you're going to be down 10, 15% for a year or two. And then when you get to the end of that period, you add them all up, and guess what? You're close to zero.
It's zero. Yeah.
Now this is important though. You're near zero on a buy and hold basis, right? This is why I don't like buy and hold strategies, because in active management, I can take advantage of those declines, avoid those. I don't have to short them. I don't have to try to participate in them. I can just avoid the downturns, participate in the upturns, and create a much better rate of return for my clients over that course of that period of time where returns are zero. I can still manufacture them 6 or 7% annualized rates of return to help them meet their financial goals.
So there are 2 points I was taking this to, and that was exactly
Yeah,
one of them, which is in a lost decade, it doesn't mean that you can't actually have gains over that period as an investor, but it means you have to adopt a much more active strategy, which, as we've ranted on a lot of times in the past, is exactly what we've been training people out of the past couple of decades,
exactly.
right? Just buy the dip, just buy the index, everything goes up, just buy and hold, time in the market, all that type of stuff, right?
Well,
So,
and but that to your point, we I'm not going to rehash the whole point, but that was part of that article as well as buy every dip. It's that whole
mhm.
Michael Green passive indexing, mindless robot impact. That impact of all that passive investing in the markets is changing the market dynamics. And again, it's fueling. I just posted a chart this week. There's 70 million 401k plans in the country. A lot of those are invested in what they call target date funds, which
Yep.
are just these very simplistic funds that are supposed to adjust your risk tolerance as you go close to retirement. They're the worst funds you can have in your 401k plan. If you're in them, you should get out of them immediately. But
What's
most
the
people,
punchline for that, just for folks watching who have them?
well, the punchline is that they don't adjust like they're supposed to. Again, you take a look at a lot of these are supposed to be like 1 year to retirement, and they're like 70% equities,
Okay.
right? They're supposed to be mostly fixed income, but so they don't do what they're supposed to do. You're much better off managing your allocation. But there's all these mutual funds that are just, if you don't make a choice in your 401k plan, you automatically get allocated to a target date weighted fund. Um, all of those are feeding into Nvidia, Microsoft, Amazon, Google, et cetera.
Yeah, they're a
Every
huge part of the
day,
giant mindless robot. Yeah.
every day, Nvidia gets $1.9 billion worth of new funds every single day into its stock. So you just think about that every day, $1.9 billion is buying just of those funds. That doesn't include the other 500 ETFs that Nvidia is in, because it's in S&P indexes, it's in the Qs, it's in every index that tracks the
Yeah.
S&P, every index that tracks Qs, every index that tracks, AI, every index that tracks, technology, just down the list, right? Um, so, every time somebody buys one of those funds, it's just funneling money into Nvidia stock price. So yeah, you keep asking me, is like Nvidia going to keep going up? Yeah, as long as people keep buying ETFs, it's going to keep going up. And that's the problem with the market.
Yep. Okay. We've ranted about that a lot. I'm sure we'll rant about it in the future. So I don't want to rant
Yeah, we
about
won't get
it
off
today.
onto it again, but I think it's an important point when we're talking about this situation. We can't exclude that impact of that passive indexing because it's changed so much of how we need to think about markets. When we get concerned about valuations, like, oh, valuations are high. Yeah, I get it, but right.
Yeah, this was, Jim's point, which is it's a bubble, but the bubble could still go higher, potentially significantly higher from here. So
Yeah,
don't lay in front of that steamroller, more or
correct.
less. The other point I wanted to bring this to, though, was assuming that he is right, you are right, and really the scope of market history is right, right? That when valuations get this stretched, future returns are low,
Mhm.
right?
Yep.
So if you're watching this video and you're 70 years old, you got to really take this into consideration, right? So, in the near term, hey, there might still be a fun game to be played here, but if we indeed enter what Jem thinks could happen here, that's pretty much the rest of your active investing lifespan, right?
Hmm.
And so what you got to do is not be looking at your statements over the past 10 years and seeing your average return and just assuming, okay, well, that's going to, as long as that continues until I'm 80 or 85, we're going to be fine in hitting our targets, right? Um, Especially if you're like most people, just sort of taking the average passive investing approach here, right?
That's
So,
right.
to your point, Lance, you've got to be mindful that it might be tougher sledding once we have the reckoning to, with this bubble that we're in. Doesn't mean you still can't have a positive track record, but to get there, your odds are going to be better with an active approach than with what's been working up until now.
Yeah. And again, we go back to talking about, I've used this example on, my daily podcast, which is, it's not hard to generate returns in markets, regardless of what's going on. If I just split a portfolio down the middle and put 50% in 10-year treasuries that just say are yielding 4%, that's a 2% return for my portfolio right there. If I put the other 50% in just good quality, fundamental, dividend yielding stocks, I can build a portfolio. In fact, our dividend growth model that we have on SimpleVisor yields about 3.7%. So let's just call it three, just make, because I need easy math. It's too early on a
Mhm.
Friday morning. No, I can't have coffee right now. So
No worries.
I need easy
But that's
math.
5% right there, just on the income.
Well,
Yeah.
no. You got to take 3% dividend yield, split that in half. So that's 1.5 plus 2% from our
Oh,
bonds, right?
sorry.
So
You're right. You're right. You're right.
that's
You're right.
but that's 3.5%. So if my goal for retirement is to only generate a 6% rate of return to meet my financial goals,
You're half the way
I've
there.
already knocked out half of it just in
Yeah.
dividend yields and income. If the market crashes, my bonds are going to protect my principal because my bonds always mature at face value. So I don't have to worry about 50% of my capital going to zero. If the market continues to perform, all I've got to do is generate roughly a 5 or 6% rate of return out of the 50% of my equity portfolio, which isn't a stretch. If markets are going up every year, I should be generating on average 5, 6, 7% in just good quality stocks, kind of along with economic growth and inflation. Well, there's your 6% return, and you don't have much risk. That's a very low volatility beta portfolio. Lets you sleep well at night. You don't have to worry about, oh my gosh, what's Nvidia going to do? Because you don't own Nvidia in your portfolio. But the problem is that we get distracted. As investors, we're all like dogs now. It's like squirrel. We have this goal, and I talk to people about this all the time. They're like, okay, Lance, just listen to me. I'm very conservative. I just need 6% a year to meet my goal. Yes, sir. I can build that portfolio for you. Super easy. Build the portfolio one day later. Why don't we own Nvidia? Right? Why don't we own Palantir? Why don't we own these other stocks? Because we get distracted by all the squirrels. We forget what our goal was. Our goal was 6% a year, but I could be getting more if I just do this. We got to remember we're taking on that excess risk profile to do that. And we have those stocks in our portfolio, but we counterbalance them with a lot of really boring crap. Procter and Gamble, Berkshire Hathaway, those type of things. Good example today is just, let me just take a quick look. Where's the market right now as we're talking? Market's down 72 bips as we're talking right now. So the S&P is down 72 bips as we're speaking right now in the markets. So if I go look at just how we build out our 60/40 model as a good example of this, now I can tell you right now, I haven't looked yet, but I'm about to look. I can tell you the portfolio will be down today because we own some of those high flying stocks, right? But the question is
Hmm.
because of the balance between the fixed income and the balance that we have with kind of the boring, stocks in the portfolio, we should be down less than the overall market. So the portfolio is down 23 bips, market's down 72. A 60/40 allocation is down 47 bips. So our benchmark is down actually 47 basis points. So our portfolio is down less than our benchmark by almost 50% and down substantially less, almost 70% less than the overall market itself. But see that, you look at the market, you go, market's down 72 bips. Oh my gosh, what's going on? And you look at your portfolio, it's like, oh, I'm down 23 bips. Who cares? That's the important thing about understanding beta volatility. And again, to your guest point, understanding volatility compression, those type of things, and how beta affects your portfolio over time is also a function of how that beta affects your psychology and allows you whether or not you can weather owning a portfolio over time to build to your financial goals.
Okay. Um, all right. Well, look, you know, I think very important topic we just covered here, but I think folks get it. Let me go into some of the data that we've gotten recently, Lance, because
Sure.
I want to talk about there's a lot happened with the Fed since
Yep, yep.
you were on last Friday.
The whole Lisa Cook saga.
I mean, that's just one piece of it, right?
Yeah.
And I've got some questions for you around that too. Um, but the day we're talking, the latest PCE data came out,
Hmm.
and that data, was in line, right? I mean, no surprises there, except maybe to those people who are saying, look, tariffs are, going to send prices to the moon, right? It came in as expected. I think it was 0.3% month over month.
PC prices 0.2, core was 0.3, both right on the screws.
Okay, yeah. So core is 0.3. Okay, right, and right on the screws, like you said. Wages were up 0.4%.
Hmm.
So, basically in just the past month worth of data, folks, but wages growing faster than costs and spending was 0.5.
Right.
So, people are
Which
still
means we're
spending.
spending more than we're making.
Spending more than we're making, but for some reason in America, that's a good thing when you're talking about the economy, right?
Exactly. Exactly.
Yeah. Um, so,
Now, but real quick though, you flip that coin, and again, that's all good news. And one thing that we've talked about a lot is that underneath the surface of all this, the economy is actually slowing down. Chicago PMI came in at 41.5. It's expected to be 46. That's down from 47.
let
Uh,
me interrupt you because I
Go
want you
ahead.
to finish your thought here, but let me just inject one data point so you can
Sure,
react
sure.
to it
Go
because
ahead.
it
Yeah,
was
yeah.
my next question, which was, looks like the economy, we've talked about how it's slowing right here and prices aren't running away. But we did just get a revision of the Q2 GDP number, which was high when it came out, and they revised it even higher.
Right.
So the question to you was, is the economy maybe stronger than we thought? Probably not for the reasons you're about to say, but I wanted to get that question out there for you to react to.
Sure, sure. No, the GDP revision at 3.3 doesn't really reflect what's been going on since the end of quarter two. So remember, since the end of quarter two, that's where we saw, weaker employment. We've seen a downturn in some of the economic activity. So we're still kind of working on getting, kind of quarter two data in. I kind of expect that 3.3 to get revised closer to 3 by the time that we get the third revision in next
Okay.
month. Um, so again, but again, you have to remember that was quarter two was, and you got to really kind of throw it out the window. You got to throw quarter one out the window too, because remember, quarter one was negative. And that was all based on tariffs. And that was all the inventory stocking ahead of tariffs. And that caused the big drag and the import export factor of GDP. And then that reversed very sharply in quarter two. So we had all these imports that kind of boosted in the other direction. So throw those two things out. They don't really reflect what's going on actually in the economy. A lot of the other economic data, leading economic indicators, Chicago Fed National Activity Index, employment reports, all these other things are showing that the economy, now the economy is not going into recession, right? ISM services and manufacturing, if you do that, if you weight ISM services and manufacturing, according to where we are economically, which is 70% services, 30% manufacturing, we're right at right on the cusp of going into contraction. So a lot of this data doesn't say we're in a recession, but it certainly suggests the economy is not nearly as strong as what headline numbers suggest, like GDP. Certainly not as strong as what a lot of the kind of the stock market suggested is. Underlying weakness is definitely there. And then we take a look at corporate earnings as a good example of this. Outside, so you take a look at quarter two corporate earnings. All the earnings growth came from the Mag 7 and about five major banks. Outside of that, there was no earnings growth across every other sector. So if the
Hmm.
economy is doing well, we should have at least seen some earnings growth out of those other sectors of the markets, and we're just not seeing that occur. So the underlying economy is clearly a lot weaker than it looks like on the surface, which does foster to the point that the Fed should be cutting rates. And I've talked about that before. But it also tells you why. In fact, today's post on our website, which is also, you can follow me on Substack at Lance Roberts, or go to our website, realinvestmentadvice.com. I just posted a piece about energy prices. And energy prices have a very, very high correlation to economic growth. And I really don't need to tell you what's been going on with energy prices lately.
Right. And you really don't need to tell people why they're so tightly correlated, because you need energy to grow the economy. If demand for energy is lower, then you would expect lower economic growth. Okay, so look, I mean, these are probably all reasons why Powell gave the speech he gave at
Mhm.
Jackson Hole last Friday, right?
Yep.
And it was interesting. So we talked, Lance, before his speech, like an
Right.
hour or two before his speech, but now we know it. And I've remarked this a couple of times, but I'll bring it up here just to give you a chance to react to it. All year up until now, Powell was the optimistic one, right? At his press conferences, where normally he just gets a whole bunch of softballs. I will say this year, more journalists than I'd seen in years past did kind of dig in a bit with him. Like, hey,
Mhm.
you keep saying that everything's great, but we're hearing these stories about hiring freezes, or we're hearing about how hard it is to get a job out there. Are you sure the labor market's doing well? And he would say things like, economy is strong, robust. I mean, he used all those languages. And when it came to the jobs market, he would say robust, but he would say, yeah, it is cooling, but we're not seeing anything we're worried about. It was a really tight labor market, so this is all normalizing. This is all
Right.
more or less what we're hoping to see, right? And it seems like on last Friday, he sort of said, "Ooh, oops, we've been looking at the data here, and it's getting worse faster than we expected." And he called out the jobs market specifically. He also called out the housing market. I've had a number of housing analysts on this program this past week. I won't rehash everything we went into those interviews, but they were great. And folks, if you want to watch them, go watch them after this video. Um, but two really big things that end up driving consumer spending seem to be weakening enough to the point where it's finally gotten Powell's attention here.
Yeah, absolutely. And and again, I told you that the Fed was going to be very late to cutting rates, and they are late cutting rates. A
Yeah,
lot
it's
of
such a tough prediction when that's
yeah,
basically
I know,
always been
right?
the case, right?
Exactly. But there was plenty of this evidence available, and again, Powell's problem, and I wrote an article about this about 3 months ago, I guess, and talking about how Powell was stuck. He was trapped by this whole transition, this whole transitory inflation that he had gotten himself into back in 2020, 2021. It's like, oh, inventories, inflation's transitory, it'll go away. It did. It just took longer to go away than what he anticipated. So now he's so afraid of inflation coming back now that he's been very hesitant about cutting rates probably longer than he should have been, because again, and the tariffs are not causing inflation. There's a lot of reasons why tariffs don't cause inflation. We've written numerous articles about why tariffs don't cause inflation. Consumer choice is a big factor in that. Um, but what you're seeing going on in the housing market, what you're seeing going on with the overall economy itself, and that's again why you're not getting inflation. Inflation is a function of supply and demand, not just prices. So, you know, supply and demand is what drives prices. That prices are the end part of that equation, supply and demand first. So that's why these things aren't showing up. And now they're starting to come to the realization that maybe that just might be the case. So unless you get some strong uptick in economic growth,
Right.
the risk of him, you know, having waited too long increases. The longer he sits out here not cutting rates, the larger that percentage chance he's going to be behind the curve and cutting rates, because we get a sharper downturn economically speaking, increases.
Yeah, no, I agree. And I'm sorry to chuckle there when you said unless we get a really sharp upturn in economic activity. Um,
Well, no, there's just nothing there to support that right now. And
I
there's
would
one
say
thing,
could,
but there is one thing.
yeah,
Yeah. Um, you
Taylor
know,
Swift, you're right.
well, okay, two things. Two things is Taylor Swift, right? That's one. The other thing is I'm actually about to. I wrote an article previously about how artificial intelligence could solve your debt to deficit problem by creating economic growth. And Nvidia just put out some projections on data center build out, which is it's about $4 trillion over the next 4 years. Utility companies are going to have to spend $1 trillion in infrastructure build out over the next 4 years as well. So
Mhm.
that's 5 trillion altogether. When you do infrastructure build out, that's a 3 to 1 multiplier on the low side. It's generally about 4 to 1 to 5 to 1 is what the economic multiple is in the economy.
Mhm.
But let's just use, if we just use the low number, 5 trillion, that's $15 trillion worth of economic activity over the next 4 years. That's gonna sharply that should bring your GDP run from about 2.5% to closer to 3.25%, if that
Yeah.
occurs. Now, those are pretty lofty estimates on spending by a
Mhm.
handful of companies, but that's one thing that could change the dynamic from a much more slower growth economy to one that's actually starting to grow again. Now, whether or not that happens, I have no clue. But I'm just saying is that two things could change that denominator effect, which is paying attention to what's happening on that spending side.
Sure. So question for you there is, when would you start to see the impact of that if it were to happen on that projected timeline?
In theory, you should start seeing it by middle of next year. If
Yeah.
if these because it takes about a year. So let's just say we all start today, right? I'm going to build a data center. It's going to take me about a year to buy the property, put the plans together, do the engineering
Get
before
the
I
permits.
even break dirt, right? It's going to
Yep.
take about a year. So
Yep.
we should start seeing some incremental effects of that CapEx spend out for AI sometime next year, if it's going to occur.
Okay, okay. And so look, I think that certainly could happen. And I think there's actually other things that are going on based on the new administration's policies
Mhm.
that, love them or hate them. I think a number of them, if they end up being affected in the way in which they're intended, will also boost economic growth. My point is I just don't see any of that happening in the next 6 to 9 months in any material way. And I do see a lot of headwinds and cracks, like we've talked about.
Mhm.
And we also have just higher for longer, right? I mean, I know we've all forgotten about it, and nobody likes to talk about the lag effect. I've stopped talking about it because it just hasn't arrived. I was talking with Danielle DiMartino Booth earlier this week, and she mentioned it, like, and we're beginning to see it. And I was like, God bless you for saying that.
I know,
Um,
right?
but it's real, folks. I
Yeah.
mean, the higher for longer does matter. The longer it takes the cavalry to arrive, the more gravity and erosion those high
Mhm.
rates have on economic activity. So,
Yeah, and
anyways,
I absolutely agree with you there. And over the I think the big risk to the markets is over the next 6 to 9 months.
yeah, okay. So we're seeing it similarly. Okay, so a couple quick things, and look, we could talk about this forever, so let's keep it real quick because I want to get back to the Fed. But when talking about Nvidia, I was reading an article this morning saying that it's such a unique, unprecedented stock in terms of how unbelievably it's doing and how much of the economy it's driving. And look, I believe AI is real and all that stuff, right? Were we in an AI bubble? I'm sure we are, but how
Yeah.
big of the bubble is, I don't know, right? But when you look at Nvidia's revenues, they, I mean, like probably 75% of its revenues probably come from like 4 or 5 companies,
Yeah.
right? And everybody has to spend right now because it's an existential arms race, right? Does Google want to be relevant for the next 20 years? Well, it's got to be really successful in AI, so it's going to spend like crazy. Same with Microsoft, same with these other players. Um, but it just raises the question, right? If even one of those clients stumbles, it's
Uh-huh.
such a tremendously high percentage of NVIDIA's revenue that it can make a really big disappointing difference, right? And I'm just curious,
That's
how
right.
much do you think about that?
A lot. I mean, that's why you pay really close attention to, all this stuff, particularly when you've got large exposures to for people that have large exposure to single stocks. Again, Nvidia for us makes up 3% of our portfolio. I mean, it could go to zero tomorrow and it doesn't affect our portfolio that much. This is the whole point about risk management, sizing, those type of things. But yeah, we pay a lot of attention to that. And again, but that's all going to get reflected in the price because the market will know that before they get to earnings. If you're just sitting around and you don't pay attention to Nvidia and you just wait for earnings, you're going to be in a bad spot. The markets are going to tell you, this stock, if they're losing a customer, that will get out into the markets and you'll start to see the stock price decline. Markets will start pricing that in. That's why it's really important to pay attention to your technical analysis when you're breaking key support levels, when you're reversing trends, those type of things. That's that's where you start reducing risk, rebalancing your portfolio, doing those type of things, those gardening things that we talk about often. That's the process of managing that risk because it's eventually going to happen. I mean, if you just look at Nvidia stock, just it was 140, $50 back in November of last year. It went all the way down to $90 in April. Now it's back up to $150 again. Now it's selling off a little bit here. So, again, this stock goes through very, very big swings over time, and gives you tons of opportunities to buy things cheap. And that's when you want to be looking for those opportunities.
Okay. All right, back to the Fed here. I think I know your answer on this, but let me just get it out there again, just so everybody hears your latest. It seems that the Fed is now going to cut.
Yeah.
I think the probability that an era of rate cuts lies ahead of us is
Hmm.
pretty good at this
Hmm.
point in time, right? So assume the Fed does cut multiple times this year and into next year. In your estimation, are you expecting bond yields to come down commensurate with it? Or could we have a situation, which some of the analysts I've interviewed on this channel, even this week, a few have said, I think the Fed will cut, but bond investors are going to be disappointed.
Well, historically, when you look at when the Fed starts cutting rates, bond yields tend to rise for a little bit, and that's what you should expect. So, but that's already happened. The Fed's already been cutting rates. So again, they just took a pause. And so they're going to start cutting again. And so yeah, if you're looking for an immediate drop in the 10-year yield because the Fed cut rates, that may or may not happen. There's not, the difference between the Fed funds rate and the 10-year rate is not that closely correlated. 10-year rate's driven by economics and inflation. So what you're paying attention to there is you're looking for inflation to fall and economic growth to slow. That's coming. So we're seeing that now. Again, see the Chicago PMI today. You saw that in the inflation, the PCE reports today as well. If we continue to see inflation and economic growth slow as the Fed is cutting rates, then 10-year yields will eventually fall, but they could stay where they are for right now for a while, kind of hang around this 4.2% range because that's where economic growth and inflation is when you add them together. However, if the Fed starts having to cut rates aggressively, because now they've realized that, hey, we're on the
They're
brink of
too
a
late.
recession or whatever it is, and
Yeah.
they start cutting by 50 basis points, or every meeting they're cutting and saying, hey, we're going to keep cutting now because we don't know. Or if something comes up where the Fed has to cut really drastically, like in 2020, 10-year yields are going to drop like a rock.
Okay. All
Now they're
right.
not going to go back to a 0.5% again. So everybody
Mhm.
expecting 0.5% yields on 10-year treasury and a 2% mortgage rate ain't ever going to happen again. But 10-year yields at 2.5 to 3.5%, very likely at some point.
Okay. All right. All right. So I'm going to just put you on the spot here. I'm not going to hold you to
Sure.
this, Lance, but probability wise, what do
Mhm.
you think is more likely? We have sort of anemic but still positively growing economy over the next year, or as history tends to show, when the Fed starts cutting, when you look back retroactively, it seems to be that's where the wheels came off, right? Where
Yeah.
generally when the Fed has hiked, held steady at a plateau, and then gets serious about cutting, that's where they usually backdate the recession to. That's where you see the
Yeah.
Fed panic cut, as the economy. So what do you think is more likely here?
Well, yeah, look, this goes back to really 2020, and we've been talking about this for a long time. It's like everybody was sure we are going to have a recession back in 2022, remember?
Hmm.
And we're like, no, we're not going to have a recession here. There's too much money in the system. And so we've been working through the whole, hey, look, we get to bring up pig in a python again. So, we talked about that whole pig in the python of all that money. That money's still in the system, still working its through. I mean, we're about to give $5 billion to Intel for a 10% stake. That was that CHIPS Act money that was already out there and just hadn't been used yet. So that's
Yeah,
going to happen. But that all affects economic growth, and it keeps that economic growth rate from slowing into recessionary territory. Also, we talked about the fact we were running at 12, 13% nominal GDP. So to get to a recession, you got to get all the way down to zero. That just took a long time to get there. Now we're running around 2%. So we're much closer to that risk
right.
of dropping into a recessionary drag at some point. So I think the odds favor that over the next period of time, I don't know when, but if we don't start to see an impact from Taylor Swift or AI spending, data center spending into economic growth, I think this economic growth is going to kind of continue to decline. We're seeing, stress in consumer delinquency rates. We're seeing stress in the housing market. That certainly weighs on people's net worth. We're seeing stresses in areas where consumers are really having a much tougher time spending money, and that's why we're starting to see some of this other incremental pressure in the market. So unless something changes that dynamic, I think the risk, is potentially there that we could see a recession sometime, next year or beginning of 27.
Okay. So, I mean, yes, the potential is there for all the reasons that we talk about every
Yeah.
week. I'm going to put words in your mouth. You can correct him, but I think the answer you gave was the answer I expected, which is all things being equal right now, you would bet, you would think the probability is more likely that history will repeat here, right?
Right.
Which is that, yeah, as the Fed
all
starts
all
cutting
all
here, we're going to
things
look back on this
all
period.
all things being equal, Taylor Swift breaks up with Travis Kelce, and AI data centers don't come to fruition, you'll have a recession.
Yep,
Yes,
the breakup is the black swan nobody's talked coming.
exactly.
So another thing here, just not for nothing, is you wrote that article in October of 2022, and when everybody, and honestly, Lance, I think even you and I, to be honest, like
Mhm.
still thought a recession was more likely. Everybody thought it was going to happen. I think you wrote that piece saying, folks, it might not, and this might be the right time, but
Yeah.
again, nobody knew for sure. But back then I remember you saying like, look, it sure seems like we are, I don't know how we're going to avoid a recession, but you were very uncomfortable because you're like, absolutely everybody is on that side of the boat. And when that happens, right? So,
Now everybody's on the no recession camp,
well, I
so
was
I'm
going to
feeling
say,
better
yeah,
about my call.
exactly. So that's what I'm bringing up here. So in talking to Stephanie Pomboy this week, she talked about how, you know, everybody was expecting recession. So she went and played around with Google search on how many people are searching for recession right now. It is totally cratered since,
Mhm.
past couple of years. It had spiked earlier this year, like during, Liberation Day and all that stuff. Everybody was freaking out about a recession, but now that's all gone. And she was trying to like text, see, compare it to other things that had fallen out of the public view. So she compared it versus searches for Kamala Harris. And she was like, actually, there's a lot fewer searches for recession than there are for Kamala Harris right now. Even Kamala Harris's searches have cratered since,
Sure,
the
sure.
presidential race. So, I mean, right now, to your point, I mean, very few people are on the recession side of the boat here, which kind of, in some ways, from your logic, makes it more likely to happen,
Yeah.
right?
It's a contrarian thing, right? If nobody's expecting it, it allows something to occur, right? So as is always, and that's why, and I am a contrarian investor. I'm always trying to bet on the other side of something. Um, but yeah, so I feel much better about a call when I'm kind of sitting in the outside.
Yep.
When everybody agrees with me, I'm like, okay, I'm probably wrong.
Okay, I'm looking at the time here. We got a lot of wood to chop and
Yeah, yeah,
not a
go.
ton of time to do it in.
Let's go chop wood.
Let's finish up on the Fed here. So
Yep.
a lot of drama at the Fed. So obviously there's been a lot of drama about is Trump going to replace Powell, whatnot, and who's going to be the replacement. And I think right now everyone's sort of figured, okay, Trump's probably not going to remove Powell before Powell's tenure is up. But there's been a lot of renewed speculation on they are expanding the field of candidates to replace Powell now.
Yep.
But basically, everyone is assuming, okay, there's going to be a Trump-friendly Fed chair being put in office next year. Now, we just had Stephen Marin come in and replace Kugler on the
Hmm.
FOMC, right?
Yep.
And that was sort of a bonus surprise for Trump, right? Oh, okay, now I can stack the board with another person who, is going to vote my way. And then now there's the drama around Fed Governor Lisa Cook, who is also a voting member of the FOMC.
Right.
I've got some questions for you around this, but first, anything specific about Cook you want to talk about before I drive this?
No, I don't think so. I mean,
Okay.
there were some new developments today, but we
Yeah.
can, I'll probably tie into everything else. So go ahead.
Okay. So, there's an increasing chorus that's saying there's a coup going on at the Fed right now.
Hmm.
That Trump is stacking it, trying to stack it with a majority of folks that he can control, right? And look, I mean, Powell's tenure was going to end, so that's not something Trump is had any real say in. The Kugler-Marin thing was just kind of serendipity, I think. But there are people that are saying, okay, but so soon after that, and now they're trying to push out Cook, right? And I had a really interesting debate on X yesterday. Wasn't really trying to, curious what you think here. So um, here's the question that I have, or here's what makes me uncomfortable. Is Trump trying to engineer a coup at the Fed? I don't know. I'm sure Trump, being Trump, wants people there on the Fed that you know will follow his lead. He's
But
just the kind of guy.
wouldn't any president want that?
Yeah, I mean, so
If,
wouldn't any president, right? Yeah. So
yeah, if JD Vance or if Joe Biden was still president and these opportunities were coming up, wouldn't he
right. I
appoint people that
mean,
were favorable to
and
him?
Biden put Lisa Cook in there
Yeah,
for
yeah, yeah, exactly.
right. So,
So I mean, yeah, that I don't think anybody's engineering anything. I think there's some fortunate events that are occurring. They're allowing him to, appoint people he likes.
he likes. Okay. So a couple of things falling out of that. So the Lisa Cook thing, here's the discomfort I have with it,
Okay.
right? So first, let me say, if she is proven to have engaged in criminal wrongdoing, absolutely should be replaced, right? No
Okay.
problem with that at all.
Yep.
I'm worried, I'm not super comfortable with the president himself interceding here to say, I've heard some stuff. It makes me uncomfortable. I want you off, right? This constitutes for cause.
Right.
Um, I feel like, wait a minute, we've had examples at the Fed before where Fed governors were involved in stuff that didn't smell right, and
Mhm.
there was a policing process at the Fed that eventually showed these guys the door, right? Like isn't Jay Powell the boss, Jerome
Yeah.
Powell the boss of the Fed, and shouldn't we let this either run its course, or um, should the president wait to get involved until there is like a legal verdict on this? Because the
Well,
fact that
he, he
it's still all speculated right now, or not proven, it does look a little politicized for the president himself to get in here and say you're fired.
yeah, well, no, and again, Trump has already come out and said he will wait for whatever the court decides, right? So he's already said that he'll
Okay.
whatever legal process
All
needs
right.
to. Now, unfortunately,
But
Bill.
but but he has sent her a letter saying you're gone, and then
Yeah,
she's
yeah,
now
that was
doing
first. And
back and
he said that was first. And he said, I'll wait until the court decides because and then Powell should be over the charge of this. Bill Pulte from Fannie Mae just sent a criminal referral today on Lisa Cook because there's now a third home
right.
that she claimed as an investment property when she disclosed it with the Fed, but claimed as a second home when she filed for a mortgage. So there's all this, and the DOJ has now pretty much intervened as well. DOJ's pretty much following this course as well.
Yeah,
There
which I think is fine.
Yeah, yeah. No, this is all legal process, right? And that's the process we should follow. But two things that, do kind of arise here is that, you know, yes, we should wait for whatever process to occur. She needs her day in court, right? Right, whether she's right or whether she's wrong. She says it was just a clerical error. The evidence kind of does the evidence that's presented so far doesn't really kind of look like it was just a clerical error, but that's not for me to judge. That's for a jury to
Yep.
judge.
Yep. And I
Um,
smell the same things you smell, so don't get me
exactly,
wrong.
right.
Yeah.
But I do from a standpoint, there, when you're in these kind of positions, I guess is that Jay Powell should be looking at this and going, look, if this is true, got to let you go. We're going to put you on, but you should be on leave of absence right now until this is done. Right. And then you have a temporary replacement or you have a voting member or whatever, take her spot, whatever, she gets a proxy vote, whatever. But, again, I think you've just got to follow some type of legal process. And I think Powell should be, the one to determine, to your point, he is the boss of the Fed. He's the chairman of the Federal Reserve Board. So he should be the one making that decision about the Federal Reserve is a very prestigious position that the whole market looks to. So there shouldn't be any hint of impropriety at the Fed because, I mean, they're in control of monetary policy. So I think Powell should be taking this more seriously than it kind of looks like he is right now, particularly with this latest criminal referral and particularly with comments from the DOJ that in their process right now. But that's just
Yeah.
my opinion. Agree with me or not, that's just my opinion.
No, no, I think we look at this seriously, and here's why this is important to me, right? Which is I'm not a huge fan of the Federal Reserve, as I think anybody listening to this channel knows, right? But I think if you were going to have a central bank, which we do right now, right, that
Mhm.
central bank should be independent, right? And I know there's, a lot of people that don't think it is and whatever, and I hear you all on that, right? But to the extent you have one, it should be as independent as possible. And if
Well, then
it
it shouldn't. Then the major banks shouldn't have a shareholder in it.
Well, okay, but that's independent of the banking system. I agree, but it should not be politicized, right? It should be as apolitical as possible, right?
Right.
And if what concerns me here about this is if the president can basically, come in and just remove, pretty much at will anybody on the
We
Fed
should.
board that it can, right, as he can, then for any suspicion that he may have, right? Then the Fed has no independence. It just at that point it just becomes a proxy for the White House. So why even have a Fed board at that
Well,
point?
no. Well, to two things. Two things. First of all, he can't remove people. He has to. The only people the president can remove somebody from the Fed board is for cause, right? And so
Right,
it has
right,
to be but it
right,
has to be proven.
no, right, but that's what I'm saying. By the president writing that letter, basically saying, "I've
But you're
seen
missing
enough
the
that makes me."
wait, but you're missing the bigger point. You're saying the Federal Reserve Board is already politicized because the president appoints the members. So if you want an independent Federal Reserve, which would be fantastic, it should be an elected by the people board, right? So that when we vote for the president, we vote for the board members for the Federal Reserve, right? It should
Right,
be
or we vote for the chair, and the chair
there
determines
should
who to
be
appoint.
right. There should be absolutely no linkage between the Federal Reserve Board and the major banks. The major banks should not be getting a dividend from the Federal Reserve every month, quarter, whenever it's paid out. There should be no ownership by the major banks of the Federal Reserve, which there is. So, if you want, you're kind of talking out two sides of your mouth.
No, 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 I'm not. I'm
Yeah,
not.
yeah.
'Cause
Because
you
when the
could.
president appoints it, when the president appoints anything, it's already politicized.
Okay, but you're talking about what we should have. I'm talking about what we have, right? So we have
Right.
a
But the
system, but
president appoints the people to the board. He
no, no, no,
appoints
no, no, no. The
out, he
president,
appoints.
as I understand it, the president appoints the chair, right? Oh, and I guess he can appoint people to the board,
Yeah,
but then they have their tenure there, right? They only
sure.
can be removed for
For
cause,
cause that has to be
right?
that needs to have proven through court that they've committed this act.
Right. And there's a pretty high standard for cause, right?
Correct.
Here. So
Yes.
that's the independence, which is like, look, unless I do something, illegal, I'm here. And if you don't like my decision, President, tough noogies, I got 4 years left
Yeah.
on my
And
tenure or whatever, right?
that's the way it should be. Did now is your argument that Trump overstepped his bounds by saying that letter?
Yes.
Yes.
Yes,
He
and
did.
that's my
Yes, he did.
yeah, and that's my point. And I think it's dangerous. And look, I don't love the Fed, so I hate to be in this position of like defending the Fed here, but it's dangerous if it sends a signal to the world that the Fed
Yeah,
decisions really matter, right?
the market looked right through it. They said, well, he can't remove her without cause, so the letters doesn't mean anything. He took an action because he's hot-headed. That's the way he operates. I mean, he's just like, I'm running this business. This is how we're going to react. We're going to react. But again, the market saw right through it. If the market thought that, Trump was politicizing the board, et cetera, then the market was sold off a whole lot more on that whole issue. But
Okay.
it didn't. It didn't even flex to that.
I hope you're right. We can move off this because I think we largely see everything more or less the same here.
Yeah,
I just think
no, I agree with you.
I think it was a bad bungle
Yeah,
on the president's part
it
to do that.
absolutely it
Yeah.
was. But again,
Okay.
this is Trump's first term. I'm no fan of his tweeting because in his first term he was like constantly bungling himself by all just the off the cuff tweets he was sending out. But that's just his personality.
Right. Well, and here's the other thing that concerns me about this too, which is um, so let's say Powell decides to do what you think he should do, Lance, right?
Mhm.
Which is, all right, Lisa Cook, until we know what's really happened here, you're on administrative leave, you're not
Yep.
voting here anymore, right?
Yep.
To the extent this was a political maneuver by the president, he kind of got what he wanted. He got her vote off the board, right?
Yeah.
And
Well,
so
right now, Powell hasn't done anything. She's still on the
no,
board.
no, I know. Powell hasn't done it. If this happens, right? So my again, what I just worry about, sort of especially the president coming to put his finger on things like this, is if it sets the president that like, oh, this person's not voting the way that I like, let's drum up whatever we can on them. Oh, you know what? On a tax, and their taxes back in 1987, they made a mistake. It creates this incentive for political witch hunt to try to drive the outcome you want by pushing out your
Oh,
political enemies on
so
them,
kind of like what the last administration did for the presidential election,
which
sort
I
of.
thought was terrible, right? I mean,
Exactly.
look, I mean, this
The my
that's the danger you get into here, is what I'm saying. This is
No,
why this is
you're
important.
absolutely right. And that's the whole factor you're driving down to is that I think is the much bigger factor is that we have now weaponized the legal system
Right.
to
The whole
go
lawfare, yeah.
after opponent, right, left, or in the middle, doesn't matter. We have now weaponized the legal system to go after people and to pass bills that allow for the statute of limitations to be extended well beyond what they were ever done, to make legal end runs around things to try to get a certain outcome. That's got, if you want to fix the problem you're talking about with the Fed, you got to fix the problem across the board. That stuff can't happen.
Yeah. Well, look, I mean, and it is happening, and we could do a whole rant about that. But again,
Yeah,
I'm glad I remembered to mention that, because to me, that is a big part of the danger of what's going on right now with this,
absolutely. No,
right?
and for the outcome of a lot of things, I think that is one of the bigger kind of the Damocles swords that's sitting out there, is that we've moved into this environment of actions that we should not be doing across the board.
Okay, got you there. I got to move on because we're
Yeah.
running out of time here. I'm skipping over a whole bunch of interesting topics, but we'll get to them hopefully next week. Real quick, and just give me the 30 seconds on this, Lance.
Mhm.
You wrote a piece recently saying that, or you did a video this week on gold acting as a liquidity source for stocks.
Yep.
I just want to note on the day that we're talking, stocks getting hit a little bit. Gold futures are above 3,500 an ounce. They spiked in response to the PCE numbers here. Um, anything? What's the punchline on this gold as a liquidity for stocks point?
No, no, no. So yeah, you got to go watch the video. What I was talking about was is that if you look at, kind of markets in general, there's this non-corollary, kind of asset that trade that's going on right now. So you took a look at, for example, gold had been really flat and a big trade. It's been running in a big trading range now for about the last 3 months, while stocks have been rising. Gold really hasn't gone much anywhere. It's just trading up and down. It's not having a big sell off, but it's also not rising. And so it's just simply showing the change of asset flows within markets. When stocks were going down, money was hiding in gold because of worries about tariffs, et cetera. And then as stocks are rising, people are going, okay, I have money in gold. I've got big profits here. I'll take it there and I'm going to buy stocks now because they're going up. Stocks are down today, so gold is up. So money's just rotating back and forth. between these liquidity sources. And whether it's gold or Bitcoin or other asset classes, we're just seeing money. But when you're starting to talk about beta performance, et cetera,
Hmm.
looking at relative asset classes, and so you're kind of looking at this goes back to talking about money flows, right? So where you're looking at money flows going is just kind of tracking where the money's hiding and where it's not hiding, and that was the point of the video.
Okay. All right. And folks, if you want us to go deeper into that next week, we can. I'm sorry to have to rush here. All right. Two last things. We forgot to put up the S&P chart last week and show folks just where we are on the TA. Do you mind if we do that real quickly here, Lance?
Sure, yeah, yeah.
All right.
Hold on.
So we'll do that, and then we'll have you run through your latest trades.
Yeah. So hold on. This is not the that's Nvidia. Real quick. Hold on. All right. So yeah. So here's the S&P. So two things have been going on. Actually, kind of a good sign, bad sign type thing. First of all, we've got a really kind of significant negative divergence going on. So this is momentum at the top. This is MACD. At the bottom is relative strength. We've got we've got this rising market within this trend channel that's really been running ever since kind of mid-May. And we're just kind of hugging along that 20-day moving average. That's been doing well, holding good support. But we have this negative divergence building between relative strength and momentum, and that's typically not a really good sign for markets. Typically,
Right.
this just will generate into a bigger correction. In fact, if you kind of just look at momentum back over here, we had the
Right.
same negative divergence in the markets back here. It's kind of the same negative divergence in relative strength, back over here as well. And then
Okay. And
eventually,
so, sorry, Lance, just to make sure we're following you,
yeah.
we're actually seeing consistency in momentum and relative strength. They're diverging from the trajectory of the market, right?
Right, right. So
Okay.
the relative strength is weakening, markets are rising.
Yeah.
So that's just, and generally that typically that type of action precedes larger corrections. Now we're about to move into, so we're just finished, today's the last trading day of the month of September, if I'm right, right?
August.
August, sorry, August. So Monday, September the 1st, it's a holiday. But September tends to be the weakest trading month of the year. So if this negative divergence is going to show up in the markets, it's likely going to show up in September. So something just at least worth paying attention to. The good news is that money flows had been really weak for the past few weeks while the market was still rising. We had a big spike in money flows over the last several days. Tuesday, Wednesday, Thursday in particular, we had a big flow of money back into markets. So that's why markets were kind of ticking up ahead of Nvidia's earnings. So, but overall, market's still in this very bullish trend. There's absolutely nothing going wrong with the markets at this moment. Again, just kind of pay attention to this this divergence in relative strength and momentum. It just suggests some internal weakness, but it's not necessarily something that says, oh, the markets are going to sell off next week. It just suggests that we're entering into a seasonally weak month of the year, September. Returns tend to be negative for the month of September. But again, August tends to be weak too, and we just put in a 3% month. So, again, statistics are statistics, they're averages. Doesn't mean it has to be the case, but it's at least enough of a warning sign here that suggests, go into your portfolio, do a little bit of rebalancing risk, raise a little bit of cash, maybe nothing drastic, but, take some profits in your winners, trim off your losers, those type of things. I'm writing an article coming up talking about Steve Cohen. Steve Cohen is a hedge fund manager that read Point 21. And I'm leading off the article talking about risk management with a quote from him. It says, like, I look at my very best trader and he's right about 55% of the time, which means 45% of the time he's wrong. On average, his traders are right about 50% of the time, 45 to 50% of the time. So 50 to 55% of the time, they're losing money. So how is it that point 21, that hedge fund makes so much money for their clients if they're losing 50 to 55% of the time? It's because they limit those losses. So
Hmm.
again, go into your portfolio, things that aren't working, trim those out of your portfolio. You can always come back to them later. Things that are working really well, trim those back to target weights, take a little bit of profits, rebalance your risk a bit. Look to buy some of those old boring stocks and stick them in your portfolio. That'll help navigate, any type of downside draw, as we were talking about earlier, in the markets. Because if we're going to get a downside correction, it's going to be in tech, it's going to be in discretionary. That's where the hits are going to come. Communications, because Google. That's where the hit will come, and money will rotate. Again, talk about liquidity sources. money will rotate back into defensive areas. So it'll go into defensive stocks, dividend yielding, strong fundamentals. It'll go into gold. It'll go into, go into bonds. That's where it'll hide out until that corrective process works. Then those assets will become liquidity sources to buy back into the high beta momentum trade.
Okay. All right. And speaking of trades, what trades, if any, did you guys make at RA over the past week?
None this week. We're again, we monitor performance of the portfolio relative to the markets. And again, as I just discussed earlier, the markets are down, 75, 80 bips. We're down about 27 bips. We're in good shape right now. So, portfolio's been doing really well this year. Gains are good. We're well ahead of our target rates for this year. So again, there's just not a lot for us to do right now, but we're monitoring it very closely.
Okay. You're kind of in the don't screw it up
Yeah, pretty
phases right
much.
now.
Right. So it's like this. Like everything's working good. Don't mess with it.
All right. Well, look, in the remaining minutes we have here, I want to squeeze in a quick rant and then wrap things
Sure.
up. Speaking of rants, Lance, last week's discussion really did seem to resonate with a lot of folks emotionally and
Yeah,
primarily.
I wanted to say something about that. Go ahead.
Okay. Well, I'll let you say it, but I'll just preface this by saying, kind of famously, you generally don't listen to you don't read the comments on these YouTube videos.
Yeah,
I
I
hope you
don't.
broke that rule last
I
week
didn't.
because there's a lot of love and support from you from this crowd. And all I want to say is what you and your family are going through, you aren't alone. You obviously have my full support, as you know. We
Yeah.
had some conversations off camera, but this community has really got your back too.
No, and I was gonna. That's what I wanted to say about it is I was overwhelmed by the number of emails that I got from people. I didn't read the comments. I don't read comments on videos just because of the haters out there. I just don't need the mental anguish. So I did hear though from other people that there were a ton of very positive, supportive comments, and I do appreciate all the support, the prayers that I received. A lot of people thought this had something to do with my kids. No, my kids are perfectly fine. They're healthy. They're doing fantastic. My wife had major surgery last week. Unfortunately, she was diagnosed with stage 3 ovarian cancer. So we are dealing with that as best we can right now. But your support and your prayers and everything else that y'all sent to us was I shared with my wife, and they're greatly needed, and we appreciated it very much.
Yeah, all right, my friend. I didn't know that you were going to share the details there. Now that it's out in the world, um, folks, you get a sense of what Lance is going through. It's not minor, but Lance, you never know. We got a big audience here. We may have some people that have some things they might be able
Yep.
to share that may be helpful, whether it's just having gone through similar, strategies for going through similar tough times like this, or we might have some cancer specialists out there as well, even though I
Yep.
know you've got the best in the world working on her right now.
Yep.
So anyways, folks, understandably, Lance may not be as available or as incredibly dependable as he normally is for this channel, given his responsibilities. And so I have told him, which I'm sure you're all on board with me with, which is that we'll take as much of him as we can get that works for him. And whenever he's got to not be here, that is absolutely okay. His cohort, Michael Lebowitz, is sort of on call to step in whenever needed. And Lance, if there are times where Michael can't do it, don't worry. We'll figure out how to soldier on. Have that be not even the last of your worries. Have it not even be a worry on your list, but just obviously focus on the things you need to focus on.
Yeah. But no, my plan is, and look, this goes to our old conversation we had last week, is that, this is, for me, this is a very, for my wife and our whole family, it's a very challenging time right now. Um, but this goes back to our conversation last week, is this is the point where you have a choice and you can just quit, or you can say, and this is why I love my wife so very much, is, after we got the news, it was devastating. Lots of tears, lots of crying. Sorry. Um,
All right, buddy.
but, she looked at me and she says, we're going to fight. You have a choice. You don't have to fight. You can just take the consequence and go, or you can go through this horrible thing called chemotherapy and, fight. And she just looked at me and she says, no, we're going to fight because, we have too much that we have left to do. And so that's the choice we make. But this is, this is those points in time where, if you're running a business or you're, dealing with, financial troubles in your life or any of these type of things. And again, a lot of people, when we talk about things like, buying a house or saving or, trying to grow wealth in the markets, and it's so unfair because of this, that, or the other thing. And, I'll make these comments about, well, this is just where you have to kind of buckle up and strap down and get to work. And I get a lot, and this is why I don't read the comments, right? Because I get a lot of these hate comments like, oh, you're just an old boomer. You don't know anything. You don't understand what it's like today. I do understand what it's like today because, I've lived through these things. I've lived out of my truck, starting a business. I've done, I've had these hurdles in my life. And I'm not just telling you these things just for the sake of telling you these things. I'm hoping that you'll take something from it and say, look, I can do this too. You can get to whatever goal you want, but you have this choice that you have to just go, hey, I get what it is, and I'm going to get over this. I'm going to figure my way out of this problem, whatever it is, and I'm going to do whatever it takes to get there, whether it's, you've got to cut spending or save more money or whatever it is, but you've got to make those sacrifices to get there. And any success that you want in life is completely achievable. And this is why I get so mad when people talk about, capitalism sucks. We need the
Mhm.
socialist system because I'm a beneficiary of capitalism, and I understand how capitalism works, and I know how to take advantage of it because I've been doing it my whole life. And you can do it too. There's no secret to it. You just have to be willing to take the hard knocks and get up and keep going and keep moving forward. And sometimes it just seems like you just can't go forward. It just seems like it's just an insurmountable obstacle. And there's no way I'm going to get over this. But it's just like that old saying is like, how do you eat an elephant? One bite at a time. And this is why we talked about boxes last week, is just this big problem is so insurmountable. I can't get over it. I'm just done. Right. But if you can take that and break it down into the pieces you can solve right now and the pieces you can't, and put the pieces that you can't up on a shelf right now, we'll get to those later, but start solving the problems you can today, you can get to whatever goal it is. I can't buy a house. It's unaffordable. Okay, well, what could I do to get there? Well, I need to save a down payment. So let's work on that first. I can do that, right? I need to save 50 bucks a month into my savings account, or 50 bucks a week, whatever the number is. Start small, work on those little boxes you can solve today. And then as things start to mature, other boxes will come off that shelf that you can start solving now because, hey, I've got my down payment saved up. So now what do I need to do? I need better credit. Got to go fix my credit. How do I fix my credit? Right. So, but again, as those unsurmountable problems find solutions, you'll get to your goal. It may take, it won't be today and it won't be tomorrow. It might be 5 years from now, but you can get to whatever goal you want.
So, I mean, I agree with everything you're saying, Lance. I hate the fact that you're having to teach us in real time,
Yeah,
how to do this.
me too.
I hate the
I would
reasons that
prefer
are
not to
making you
be.
the model. I know.
I
Um,
prefer not to be. Trust me.
and I mean, on this channel, I bring it back more often than probably most people want to reminding people what real wealth is, right? And I generally distill it to, the important relationships in our lives, living with purpose, and then health, right? Because those are the things that really matter. I try to remind people money is a means. And even though that's what we talk about 98% of the time, Lance,
Yeah.
it is a catalyst towards that can be helpful with those things. But when you are faced with the type of adversity that you are and your family are right now, it's an immediate reminder of what really matters, right?
Yeah.
Um, and so,
Yeah.
you know,
That's a valuable point. I would trade everything right now
right, right,
for a carry.
and fortunately, you've done a good job of saving, so you can use, cash in on the financial wealth that you've built to help, give your wife the best treatment that she has that she can get, and she's very lucky to have you. I mean, you're ridiculously lucky to have her. I mean, let's not
Yeah, no
let's not
doubt.
mince words on that one. But I mean, one, you're a good provider, and obviously you've worked hard to build wealth to be able to get her the best care and whatever. But to your point, right now, uh, you all have to make your choice. Sounds like she's made hers. But is this going to break me or am I going to fight? Right. And I'm just here to remind you, Lance, that, you freaking MMA fighter. I mean, you are a fighter by your nature. It's in your DNA. She's very lucky to have a partner like you with your constitution. And so just like in Forrest Gump, right, where they just like, unleashed his natural power, right? The run, Forrest, run, right? I mean, right now is your fight, Lance, fight
Yeah,
moment in time.
yeah. No,
So,
it is. And like I said, it's and I told you this a little bit, but when we were just getting on the show this morning, is that it really refocuses what your goals are in life. Because like we had all these plans for certain things that have now all changed. And all the things that we were working for and saving for, and we were going to do this, that, and the other thing is like all that's just completely out of the window now. It's like is now it's just it doesn't none of that even matters anymore. It's just whatever it takes to give her as long of a healthy life as she can, and for us to just be together as long as we can, because it's the one thing that we all take for granted is time.
yep.
And we all think that we're gonna have plenty of time. It's like, when you're having, tough time with your spouse or whatever, it's like, I'm just not gonna talk to her or whatever. We're just gonna, just live in separate bedrooms or whatever. And, you don't realize how, and unfortunately, it takes something like this to make you refocus on what's
Yeah.
important.
Realize that you're just burning precious time when you
Yeah.
do stuff like that. Yeah.
And really think about and it's really made me reevaluate. Look, I like I said, I love my wife more than anything else on earth. She's on earth. She's like, she's everything to me, and I do everything in the world I can for her. But when this happened, it just made me take on a completely new aspect of how important she was to me. And it's sad that it takes something like this to really make you realize just how important that significant other is in your life. And I hope that if anybody takes anything away from this today, is that you just take a second to really appreciate your spouse for who
Mm.
they are. And because you hear this all the time, but you're not guaranteed tomorrow. And that's true. And unfortunately, it takes something like this to really make you realize it. And I don't wish that on anybody. So, take away from today, go do something for your spouse and just tell them thank you.
Well, look, know, my wife's been away. She's coming home in about an hour. I'm gonna give her a really big hug when she comes, an extra big hug when she comes in the door, honoring you and your wife here, Lance. I hope everybody else does the same in their life. Look, buddy. So again, heartbroken for you and your family that you guys are going through this. I do take confidence. Hopefully, it's proven over time that you were in the best of hands with the care that you're getting there. I don't think I'm letting anything proprietary out of the bag. But you
No.
live in Houston, MD Anderson is there. It is the best cancer treatment center in the
And
world,
we're
to
we
my
are
knowledge.
very no, we are very, very lucky. We have with because MD Anderson and literally the hospital is like a mile from our house. So,
Wow.
and we have an excellent doctor. She is absolutely awesome. The amount of care and support that they provide to their patients is mind-boggling. I mean, the number of people that are at my wife's disposal, they call her, they're constantly checking on her. She has all kinds of resources to access. Um, you know, one of the things when we were going through the surgery process is I'm always fascinated by business, right?
Hmm.
And from the moment that you walk into MD Anderson Surgical Center, it's a organized process. I mean, there is somebody there constantly making sure you're informed, making sure that the person is in the right place, double checking everything. You meet with every single doctor, you talk to every single nurse and practitioner that's there. And it's such and there's like 50 people coming in at one time, and they're just just funneling these people off. Everybody's getting taken care of. It's such a well-oiled machine. I'm like, I need to figure out how to run my business like this, because it's phenomenal how well, and of course they've been doing it for decades, but
Right.
it's absolutely phenomenal, how controlled that entire environment is. But the level of service and support that they give you is just absolutely amazing.
All right. Well, that's really encouraging to
Yeah,
hear.
very lucky.
Um, So, in conclusion here, Lance, because I know you got to go because you've
Yeah.
got some commitments you got
We
to
have,
get
we
to.
have an appointment. We have to go, go to.
Okay. But I hope you feel the love from this community. I mean, I hope you feel the love from me, brother.
Yeah,
We got
absolutely.
you, fight for her. Let us know how we can fight for you. And nothing but everybody's best hope and support and prayers from here. And you'll keep us updated as you are able to and make sense. But most importantly, please have your time here going forward be what you can spare and what's healthy for you, but not a minute more.
Well, no, I mean, look, I'm going to be here unless there is an appointment or something. So just, she's about to start chemo. She'll go through 6 months of basically about, no, sorry, about 4 months of chemo. Hopefully after that things will all smooth out a lot. But no, my intention is to continue to be here. I'm continuing to run my business, continuing to do what I need to do. But just unless an appointment or something that I need to be there for interrupts it, then Michael Lebowitz has already said he'll fill in. But no, my plan is to be here every Friday, and we'll keep moving forward.
Okay. Well, look, so head a rant for today. Obviously, not going to get to
But just
it.
tell me what the topic is, so I'll get ready for next week.
This was much more important. Man, topic was uh, there was sort of an uplifting part of the end of it, but how uh, you and I, and I'm sure many viewers here know, we know the people that are having like the tail end successes in life,
Yeah.
right? The guy that you're talking to who you kind of thought was like you, and then you found out that like, oh, he bought Bitcoin back in 2016, right? Or,
Yeah.
oh my God, this guy's small little business, he just got bought for $50 million, right?
Yep.
It's hard to kind of get your soul crushed in the moment when you realize, but there's an inspirational part of that. But again, this is
Yeah, absolutely. Yeah, yeah.
nothing worth talking about after what we just talked about here.
No.
But
We'll definitely save it for next week because actually, I just texted my son. He's in college at A&M studying computer engineering, and this kid at A&M just sold his AI. He built an AI program, and he just sold it for $40 million. Hadn't even graduated college yet.
yeah, you're kidding.
And
Okay,
so,
yeah,
I, so I text my son. I'm like, "What are you doing?"
yeah, I know. The absolute last thing you wanted to hear at that moment. So that's exactly what I want to talk about in that rant.
Perfect.
And in
Perfect.
general, buddy, if you ever, look, I can dial up the rants going forward too. If you just want to have a nice distraction to be able to,
Love it.
direct your attention towards something else. Um,
Perfect.
all right, look, well, folks, if you feel one of the best ways to start using your time for the things that really matter is to continue watching Lance Roberts on this program going forward every week from here, or as often as we can get him, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Don't forget again that the early bird price discount is still available for Thoughtful Money's upcoming fall online conference on Saturday, October 18th. Don't worry if you can't watch live. Everybody who registers is going to get a replay video of the full event. As a reminder, Sven Henrich just signed on. The faculty is amazing at this point and only getting better. I just had another big name commit last night, which I'm going to share. I'm going to save to share until next week. But to go get your tickets, run, do not walk, to go to thoughtfulmoney.com/conference, where you can buy your ticket there, still at that lowest discount price. And if you are a premium subscriber to our Substack, you'll get an additional $50 off of that discount price. Boy, there was another announcement I had to make, Lance, about YouTube membership videos, which
Uh-huh.
folks, I'll just talk about next week. I won't mention them here. I just plan to see that you're going to hear something from me about that coming up. And then last, obviously, if you would like to get some professional financial help in figuring out how to navigate the financial markets that we have today and may have tomorrow, given a lot of the macro issues that Lance and I talked about, recommend that most of the people watching this video get that help from a good professional financial advisor. If you've got a good one who's doing that for you already, great. Don't mess with success. But if you'd like a second opinion, or if you don't have one of those advisors, and would like to talk to one of the financial advisors that Thoughtful Money endorses, these are the firms you see with me on this channel week after week. Maybe you'd like to talk to Lance and his team there at RAA specifically to set up one of those consultations. Just fill out the very short form at thoughtfulmoney.com. Lance, buddy, I'm going to let you go. Thanks for just everything and who you are as a person, and give your wife a big hug from me today and give her my best
Yep.
as well.
I will.
And I usually let you have the last word. Anything else you want to say, or should we just let you head off into the sunset here?
No, we're all good, and we'll see you next week.
All right. Good luck, buddy.
Thank you.
Everybody else, thanks so much for watching.